I'm going to show you the main difference between Roth 401k and traditional 401k. At the end of the video, I'm going to show a simple calculation that I did in Excel that shows a clear winner, so stick around. The tax law allows us to contribute to our retirement through two different ways. 401k traditional, it's also called pre-tax 401k or deferred 401k. And the second option for 401ks is Roth 401k, that is also called after-tax 401k. So which one to choose? We gotta do the math. As an executive at in the insurance industry and the wealth management industry, I had the privilege to work on our company's 401k plan. I moved us from one broker to another. I implemented the plan, and I'm the administrator on the plan. Also, on a daily basis, I get exposure and I get to work with licensed professionals that do this on a daily basis. They advise employees and employers about 401k stuff, okay? And now we're gonna dive in. I'm gonna talk about 4 differences and 3 similarities. The 4 differences, the first 2 are what, like, if you only want to learn just one thing today, the first differences are what you need to focus on. Now, if you're more sophisticated in your investments and in your financial needs, stick around, because the second two differences, can have an impact on your finances, and the similarities as well, okay? Because there are certain terms or certain features that we need to know, okay? All right, the first difference, it is about how the contributions are treated from a tax perspective. So, traditional 401k, you do not pay tax. That's why it's called pre-tax contribution. Let's say you make $10,000 a month and you want to invest 10% of your income in 401k. So that's $1,000 every month that goes to your retirement plan. You do not pay taxes on that $1,000 now, okay? You're gonna have it as a tax deduction. So your income goes from $10,000 per month, it drops to $9,000 for tax purposes. So let's say your tax bracket, you pay 10% on your tax, okay, on your income. Now, because you got the deduction, your income, taxable income, is only $9,000 instead of $10,000. So you're gonna pay $900 in tax instead of $1,000 in tax, okay? And I have, my very first video was about tax deductions and tax credits. So go watch it if you need to learn more about tax deductions. Now, Roth, however, you're making $10,000 still. That's your income gross, okay? You are not going to take the tax deduction. You're going to pay the tax, 10% out of $10,000. That's $1,000 that is tax going to Uncle Sam. And then you will contribute $1,000 to your Roth 401k, okay? So that's the number one difference. You pay tax now if it's Roth, or you pay tax later and if it's traditional 401k, and that will take us to the second difference. It is when it is about the tax treatment of the distributions, okay? So with traditional 401k, let's say you have a balance of $100,000 when you retire, so 59 years and a half, that's the legal age to take retirement distributions without incurring a penalty or paying taxes on them. So with traditional contributions, let's say now your balance is $100,000, you are going to pay taxes on the whole balance amount, $100,000, okay? Because you did not pay taxes when you contributed during your work years. So you pay taxes during your retirement years. Do you want to do that? I don't know. You have to do the math. Now for Roth. Since you already paid the taxes, during your work years, your your contributions grow tax-free. Tax-free. Nada. So all your $100,000 balance at age 59 and a half will be tax-free. You can take it all out, tax-free, okay? You don't pay tax on the contributions because you already did when you were working, and you do not pay taxes on the capital gains, and that's the key difference here, okay? So today, if you wanna just learn one thing, learn this, okay? The traditional 401k, you don't pay taxes when you're working. You pay taxes when you retire. Roth 401k, you pay taxes when you're working, but you don't pay taxes when you retire on the contributions nor on the capital gains, okay? Now, the third difference, it is the required minimum distributions, okay? So as of right now, we're in 2024, and thanks to Secure Act 2.0, the treatment used to be the same, but now there's a difference. Roth contributions do not fall under the required minimum distributions. What does it mean? It means that for traditional contributions, 401k contributions, when you reach the age of 73, as of right now in 2024, you have to start taking money out of your 401k. So basically that money that you took out stops growing. It stops growing because you took it out. Okay, now it's in the bank or you spent it already. Okay. However, for Roth, you do not have to take RMDs. RMDs are required minimum distributions. So if you're an investor who wants to leave the max amount of inheritance to your heirs, then you should invest in Roth 401k, because you can leave your money, your investment grow for longer, because you don't have to take required minimum distributions. Now you have to be able to afford not taking any retirement distributions, okay? Difference number 4, it's about the early withdrawal, okay? For both of them, if you withdraw from your 401k, and unless you have an exception, which is usually related to financial hardship, if you withdraw money from your 401k, you will have to pay penalty and tax on it. Now there is a caveat. Roth 401k, you pay the tax and the penalty only on the capital gains, because you already paid the taxes when you were working. Pre-tax, however, on the other side, you did not pay tax when you were working. So if you take an early distribution, you're gonna have to pay tax on the contributions and on the capital gains that you got from your contributions. And you pay a 10% penalty on both as well. I'm gonna give you an example. Roth, let's say you have a balance of $100,000 of 401k, and before 59 and a half, you decide that you wanna take $10,000 out for whatever reason. Let's say out of that $100,000 balance in your 401k account, $80,000 came from your contributions and $20,000 came from your capital gains from your contributions. Now it's a low amount, granted, but stick with me, it's only for an example, okay? This gives us a proportion of 20% and 80%, okay? So you have 20% contributions and 20% capital gains. For traditional 401k, you're gonna have to pay taxes on the whole 100,000, on the whole amount of the withdrawal. Let's say you need, like we said, $10,000, you're gonna pay tax on the whole $10,000, and you're gonna pay the 10% penalty on the whole $10,000. With Roth, you only pay penalty and tax on the capital gains, $2,000. You only pay tax and penalty of 10% on the $2,000 that came from capital contributions, that came from capital gains on your contribution of $8,000. So keep that in mind, okay? I don't encourage anyone to take early withdrawals, but it happens. people have different needs. We go through cycles in our life, okay? Now, very quickly, 3 similarities. Company match. Keep in mind, whether you contribute to Roth or to traditional 401k, you're gonna, if your employer offers a company match, you're gonna, it's gonna be treated as pre-tax. So when you retire and you take your, and you start taking your money out, the portion that came from company contributions or company match and the capital gain that came from that portion of company match will be taxed at your retirement, whether it's you contributed to Roth or to traditional 401k. That's similarity number 1. Number 2, it's the borrowing capabilities from your 401k. Yes, you can borrow from your 401k up to $50,000 or 50% of your balance, whatever is lower. So if you have a balance of $90,000, you can only borrow up to $45,000. If you have a balance of $1 million or $2 million or $500,000, you can only borrow $50,000 because that's the max per the IRS, okay? So that's the borrowing. I know people that did it, and it helps with investments. If you have an investment and you're never certain, but you're very strong about it, you can borrow from your 401k, okay? So these are some strategies that some people do. I might do it in the future. Now, can you borrow against, how about the fees and the investment options? It's the same. Fees depend on the funds you invest in and not on the type of contributions you make, okay? Now, investment options, you really have no choice here. It's whatever your employer has crafted for you in the 401k plan, okay? Now, if your employer has received good advice from their 401k advisor, they should have used or built a plan that allows employees to invest in single stocks. That's what I do. I have more than 90% of my 401k invested in individual stocks that I pick myself, and I take full responsibility for my losses and for my gains. And I also get to not pay any fees because this is not a managed fund. I'm the manager. So if there are any fees, I should pay myself, right? So these are the similarities. Now, the bonus I promised you at the beginning of the video, okay? I'm gonna show you a calculation I did in Excel, and forgive me for this very not modern type of presentation, okay? So here, we're gonna go through an example that shows clearly by the numbers what type of 401k is better. So we're gonna assume that you're gonna invest $10,000 per year in your 401k for a duration of 20 years. And we're gonna say that your returns are gonna be 10% per year, okay? 20 years at $10,000, you're gonna end up with a contribution of $200,000. Now, you're making 10% a year on your contributions. I did a future value formula here to come up with a number of $572,000 at year 20 or after year 20, okay? That means your money, your investment of $200,000 that you did over the years compounded and grew to be by $372,000, okay? This is why it's so important to invest in 401k, compounding, okay? Now, let's look at the differences so we know what's better. Here you have Roth, and here you have traditional 401k. We're gonna assume that your tax rate is 22%, which is, by the way, the most common, in right now, at least in 2024. Okay, so you're gonna pay tax. Remember, Roth, you pay tax while you're working, okay? So you pay tax only on the contributions. Your contributions were, in this example, $200,000. 22% of $200,000, that's $44,000 in tax that you paid over the 20 years. Now, with traditional 401k, you do not pay taxes. While you're working, you pay taxes on the balance, the whole amount of the balance at retirement, which means you're gonna pay 22% on the whole $572,000. That gives you an amount of, right here, $126,000. That's huge, right? Huge difference. The difference is actually, if I can see it here, $82,000. That's why I said it's a game changer to learn or to know or to choose the right 401k contribution type for yourself. Now you're gonna tell me, yeah, I'm paying now taxes with stronger dollar, and in the future the dollar is gonna weaken and there's inflation, and I'd rather pay later in the future because I will be paying with weaker dollars. Yes, that's right. 3% inflation. I still did the math. $44,000 in the case of Roth, okay? And it's actually even lower, but I simplified it, okay? I kept it at $44,000, but I changed the formula to calculate the traditional 401k tax payments using the 3%. We end up paying $69,000. That's still a difference of $25,000. So you tell me what's better. Also, do you think that our tax brackets right now are among the lowest or the highest historically? I don't know about you, but I think it's more towards the lowest. I think in 20 years from here, 30 years, we don't know what the politicians are gonna do. I know we have a lot of debt as a government, and to pay it, we either inflate our way to pay it, or we will have to increase our revenue as a government, which means we have to increase our taxes. So maybe, just maybe, in the future, tax rates are gonna be higher and you're not gonna be at that 22%. So cherish it right now. Okay, so if you like the video and you feel that you learned something from it, please smash that like button. Smash it only once, because if you smash it twice, it undoes the liking. Okay, so smash it once and subscribe to the channel. We're gonna cover a lot of investment strategies, a lot of real estate stuff. Gonna be shortly, hopefully in 1 month, we're gonna start building our ADU. I'm gonna show the progress, give advice. I'm gonna talk about things that we thought about during the planning and the design process, like why do we do this? Why did we choose 1 bedroom instead of 2 bedroom, 2 baths? So subscribe and you will receive a lot of information like that. Also, make sure you share this video with your friends, with your husband, your wife, your family. Let's get more people educated, because they don't teach this at school. All right, thank you. And by the way, this video, for the first time, I shot it using a professional microphone. So thank you, Rita and Stefan, for your gift. Bye now.